Good to have you with us. Thanks for tuning into another edition of Investor's Guide. This is a show where we help you understand all about financial planning and how to manage your investments. Now, on today's show, we are going to talk specifically about ELSS schemes or equity-linked savings schemes. This is an extremely important category when it comes to your tax planning. It's also a very good way of saving taxes. So that's really what we're going to discuss and how it fits into one's portfolio. And to do that, joining me is Feroze Azeez of Anand, Rathi Wealth Management. Feroze, thank you once again for joining us on this edition of Investor's Guide. Now, equity-linked savings schemes, this is perhaps one of the best ways of saving taxes and a very strong investment avenue as well. Let's start by understanding how this particular category of mutual funds works.
Avni, this category, of course, is very contemporary in the months of February, March, where all of us like to do our investments to save that little bit of tax which comes under the Section 80C. So here, nothing but several mutual fund investors come together, and the fund manager invests 80% of the collected money in equity and equity-related instruments, and has the provision of investing up to 20% in non-equity, could be debt or any other asset class as well. So 80% of your money goes into long-term capital appreciation. That's the thought process of equity-linked savings schemes. We have about 42 of them in the mutual fund industry, and I think this has several benefits, I think, which we can speak of. But I think capital appreciation, along with the tax discount you get on day one, and the tax reduced tax of about 10-12% at maturity on the gains you have made, makes it a very, very lucrative tax-efficient instrument for ATC.
Right. And of course, the important point also that we need to understand here is that this has a 3-year lock-in period. Now, the good part is that ELSS schemes lock-in period is much lower compared to many of the other tax-saving instruments. So that's one of the big benefits. However, because of its leaning towards equity and majority in equity, it increases with the risks also increase as much.
Yes, Avni, the risks are more. The reward is more. You have a 3-year lock-in. If you look at the last 3 years, the returns have been double-digit. The lock-in is lesser, like you will bang on, because this is the least lock-in you would get under the schemes available in ATC. It's just 3 years. If you look at the tax-saving FDs, it's 5-year. If you look at the National Savings Certificate, for example, that's 5 years. You have PPF, which is a long period, about 15 years. NPS, which is up to the age of 60, you can't actually withdraw it. So this is a real liberal 3-year kind of a lock-in period, so that you can recycle the same money to get tax efficiency again and again, and still make about 10-12% return, if not more.
So for an investor, how does one sort of decide if this fits into one's portfolio? What should be the things that one really keeps in mind? Because, the other mistake that a lot of people make is invest in ELSS funds or any other tax saving scheme only to save taxes, but that's not really the right approach. It has to fit into your overall investment portfolio.
Avni, what happens is all of us will have to have some amount of equity. If we have to beat Mengai, inflation, price rise, you will have to have equity. So this becomes your first product to fill in your equity gaps. So that's why it cuts across different client portfolios, and there is a fitment in most of them, if not all of them. So make sure that this is your core equity portion, which you keep adding on a monthly basis to get the tax benefit, rather than doing a lump sum investment in the fag end of the financial year. Make a systematic investment plan. So that's point one. Point two, of course, like you said, Avni, tax efficiency or the tax break is just a peripheral, tertiary or the secondary objective. The primary objective is fitment into the portfolio from an objective standpoint, what goals you wish to achieve. For retirement, this fits in very well because it has longer periods and you have equity as an asset class to make twice more than the debt alternative, if not more.
So for somebody who's looking to invest in ELSS for tax savings and for their entire equity portfolio as well, or at least part of the equity portfolio, would you recommend sort of investing entirely into ELSS, or just the amount that you want to save tax and then the rest of your equity allocation goes into other equity mutual funds?
You're right, Avni. What should be done is only the differential of the 1.5 lakhs, whatever you get a tax break on, that's the precise amount you should invest in ELSS because you are getting tied in for 3 years. And the second attribute of ELSS, because of the tie-in, the risks are marginally higher. Numerically, if measured statistically, they are more on risk, at least 50% more on risk than a comparable large cap fund. So you're right. Don't invest more than what you get a tax benefit for when it comes to ELSS.
Okay, and what are the kind of returns that we look at when we talk about ELSS funds that we've seen in the past? Of course, that can't be the only measure that one uses to invest as well, but nonetheless, it does give an idea.
Yes, Avni, since these are largely equity investments, they invest 80-90% of the money is invested in equity out of all the 42 schemes if you check one by one. So the expectation should be about 11 to 12% at least because there's a 3-year holding period. So 12% return, which makes it almost about 2.5 times more than a fixed deposit which can save you tax. Since you have a 3-year lock-in, I would say last 3 years would have ranged between 13%, which is the best fund, to something which would have been at least 5% return, which is the bad fund for the last 3 years. So an aggregate of 10 to 12%, if you made your choice with a binocular lens to pick the right one, should be possible.
Right, and since this has a 3-year lock-in, is it something that you would recommend staying past the lock-in period? Because we do see people tend to withdraw immediately after the lock-in period, but at the end of the day, this is an equity investment, and the recommendation is always to stay invested for at least 5 to 7 years for equity mutual funds.
See, what you should do is, Avni, this 1.5 lakh ATC limit is a yearly limit. So after 3 years are over, what I would do is redeem it for a few days and go back into the same scheme if that scheme is doing well, or choose another ELSS scheme. So then you get the tax break again on the same money. But you're absolutely right. The time frames of investing in equity should be 10 years, 15 years, as much as you have till retirement. But you can recycle the same money rather than locking in fresh funds for the tax benefit, because of the 3-year lock-in is a liberal lock-in. So after 3 years, withdraw it and reinvest in the same scheme or a new one in the ELSS category, and stay invested in 3, 4, 5 cycles to up to 15 years.
Right. And Feroze, one final question. Since we've seen the new sort of tax regime come into being from last year, and that option being given now to people to opt for either one, have you seen sort of an outflow from ELSS schemes, or lesser amount of people opting for the ELSS schemes over the past 1 year?
See, Avni, net for the year, you saw about first 6 months having an inflow. If you speak of a calendar year from Jan 20 till August, there was a positive flow. September to December, there has been a negative flow into these schemes, which is generally a cyclical trend because people invest in these months. So when they finish the 3-year, there is an outflow. So I personally think there's no trend which can be derived. It's a cyclical kind of a portfolio category. But I think you touched upon a very important point, because last year there were 2 different methods of taxation available for each one of us to choose. So it's important for you to evaluate which method is better for you. It might just be that method 2, where no ATC investments need to be made, could be better for you or a family member of yours. All different family members can adopt a different method of filing the tax. So I think it requires more introspection than just a blind investment in ELSS scheme just because you get an ATC limit.
All right, Feroze, thank you so much for joining us and helping us understand ELSS funds a little bit better. For our viewers, I hope this episode has helped you understand how ELSS funds work and how you should actually use them wisely and fit them into your entire investment portfolio. On that note, thank you so much for tuning in.